Taxes. When you receive a paycheck, the amount deposited into your account is almost always less than the amount your employer tells you they've paid. This is because of taxes. Taxes are compulsory payments to the government that fund public services such as roads, schools, healthcare programs, and national defense. There are multiple types of taxes. Income tax applies to the wages or salary you earn. Sales tax applies to the money you spend on goods and services. Capital gains tax applies to profits earned from investments. In addition, most people also pay Social Security tax and Medicare tax. Social Security is essentially a government-mandated savings plan. You contribute during your working years and receive benefits after retirement. Medicare is a tax that funds healthcare for the elderly and people with certain medical conditions. When tax season arrives, individuals must file returns. The government already knows roughly what you owe, but the system requires you to calculate it and submit forms. If you calculate correctly, you are safe. If not, you may face penalties. Depending on employment type, taxes can be paid quarterly or annually. Failing to pay taxes can lead to serious legal consequences. While many dislike taxes, they are essential. Countries with higher tax rates often maintain higher standards of living through better infrastructure, healthcare, and public services. Banks. When you deposit money into a bank, it doesn't simply sit in a vault waiting for you. Instead, banks operate under a system called fractional reserve banking. This means they only keep a small fraction of deposits on hand while lending out the majority to other customers. For example, if you deposit $1,000, the bank might hold $100 in reserve and loan $900 to someone else. For a car, a house, or even something like a jet ski, banks earn money by charging higher interest rates on the loans they issue than the rates they pay you for keeping money in a savings account. You are the supplier of money, and borrowers create the demand. This difference in interest rates is called the spread, and it's the core way banks make profits. Why do people trust banks with their money? There are three main reasons. First, banks provide convenience. Debit cards, transfers, and online banking make it easier than carrying cash. Second, banks offer safety. Storing money in a bank is far safer than keeping it physically at home. In the United States, deposits are insured up to $250,000 per person through the Federal Deposit Insurance Corporation, FDIC, meaning even if a bank fails, your money up to that limit is protected. Third, banks incentivize saving by paying interest on deposits, which is essentially a small reward for allowing them to use your money. Interest. Interest is the cost of borrowing money or the reward for saving and lending it. When you borrow, interest is the price you pay for using someone else's money. When you save or lend, interest is the income you earn for giving someone else access to your money. There are two main types of interest. Simple interest charges a flat percentage of the original loan amount. For example, borrowing $1,000 at 10% simple interest means you pay back $1,100 total. Compound interest, however, is much more powerful. It doesn't just charge interest on the original amount, it also charges interest on the interest that has already built up. This creates a snowball effect where amounts grow faster and faster over time. To see how this works, imagine a credit card debt of $1,000 with a 20% annual interest rate. If you make no payments for a year, that balance grows to about $1,219 because every month new interest is added on top of the old interest. Left unpaid for years, that balance could double or triple. Now flip the situation. Imagine you invest $1,000 into an account with 7% compound interest per year. After 10 years, that $1,000 grows to almost $2,000. And if left for 20 years, it nearly reaches $4,000, all without adding a single extra dollar. The principle is simple. If you are paying compound interest, it works against you and can trap you in debt. If you are earning compound interest, it works for you and can build wealth over time. Inflation. Inflation is the process where money slowly loses its value over time. This doesn't mean the number on your bill changes. Your $5 bill is still $5, but it buys you fewer goods and services than it did before. For example, if a bag of chips cost $1 last year and now costs $1.30, that extra 30% increase is the effect of inflation. There are several main causes of inflation. The first is demand pull inflation. This happens when too many people have money and want to buy the same limited goods. For instance, if thousands of customers all want a $500 TV but the store only has a small supply, the store raises the price to $800 because demand is higher than supply. The second is cost push inflation, which happens when it becomes more expensive to produce goods. For example, if the cost of raw materials or shipping increases, companies raise prices to cover their higher costs. The third is expectation-driven inflation. If people believe prices will rise soon, They rush to spend their money before things get more expensive. This increased spending itself pushes prices up, creating a cycle. A small, steady amount of inflation, around 2% per year, is considered normal and even healthy for an economy. But when inflation spikes too high, it erodes savings, reduces purchasing power, and outpaces wage growth. To control this, governments and central banks often raise interest rates, making borrowing more expensive. This discourages spending, slows down demand, and helps bring inflation back under control. Recessions. A recession is a period when the economy shrinks for at least 2 consecutive quarters or 6 months. In practical terms, it means businesses are struggling, unemployment rises, and consumer spending falls. You might see companies laying off workers, stock markets declining, and families cutting back to only essentials. Recessions can be triggered by different factors. High interest rates can make borrowing too expensive, reducing both consumer spending and business investment. Global crises, such as wars, pandemics, or disruptions in shipping, can also cause widespread slowdowns. And sometimes recessions happen naturally as part of the economic cycle, a repeating pattern of growth, peak, decline, and recovery. You can think of the economy like a party. In the growth phase, everyone is spending freely, companies are hiring, and money flows easily, but eventually the pace becomes unsustainable. When the cycle turns, reality sets in, and the slowdown becomes a reset. Governments respond to recessions in several ways. They may lower interest rates to make borrowing cheaper, send out stimulus payments to boost spending, or provide direct support to struggling industries. While recessions are painful, they are not permanent. Over time, businesses recover, jobs return, and growth resumes, though not without leaving lasting effects on workers and companies. If you are enjoying this video, click on the like button and don't forget to subscribe and leave a comment below. Credit scores. A credit score is a 3-digit number that represents how reliable you are at paying back borrowed money. It doesn't measure how wealthy you are, it measures how trustworthy you look to lenders. In most systems, scores range from 300 to 850. A score below 580 is considered risky, while anything above 750 signals strong creditworthiness. Most people fall somewhere in the middle range, around 640 to 790. Credit scores are calculated using several key factors. Payment history. Do you pay bills and loans on time? This is the most important factor. Credit utilization. How much of your available credit are you using compared to the limit? Keeping usage below 30% is generally best. Length of credit history. The longer you've had accounts open, the better. Credit mix. A variety of credit types, credit cards, mortgages, student loans, can help your score. New credit applications. Applying for too many new accounts in a short period can hurt your score. Improving a credit score comes down to consistent good habits, paying bills before the due date, keeping balances low relative to credit limits, and avoiding unnecessary applications all help. Importantly, having no credit history at all can still result in a poor score, because lenders don't have enough information to judge you. A good credit score makes it easier and cheaper to borrow money. It can mean lower interest rates on mortgages, car loans, and even better approval chances for renting a home. In short, it's not about how much money you make, but how well you demonstrate reliability to lenders. Currency or money. Currency or money is not valuable on its own. It's valuable because people agree it is. A dollar bill is just paper, but society accepts it as a medium of exchange. That shared belief gives it purchasing power. Without collective trust, money is no different from a piece of paper or even a stick. Money makes trade far easier than bartering goods directly. Instead of exchanging a goat for a bag of grain, you can use money as a common standard of value. This allows economies to grow, systems to organize, and complex societies to function. Governments and central banks play key roles in regulating money. Governments issue currency while central banks control how much of it circulates. If too much money is printed, it leads to inflation, reducing the value of each unit. If too little circulates, people cannot afford to spend, and economies slow down. Different forms of money exist. Physical cash is the most familiar, but digital money in bank accounts now dominates daily transactions. Cryptocurrencies like Bitcoin challenge traditional systems by existing without a central authority, but their legitimacy still depends on whether people believe they hold value. Ultimately, money is a social construct built on trust. It works only because people collectively agree that it represents value and can be exchanged for goods and services. Investing. Investing is the process of using your money to generate more money instead of letting it sit idle. The goal is to grow wealth and protect it from inflation, which reduces the value of money over time. When you invest, you are trading money today for the chance of having more money in the future. There are several main types of investments. Stocks. Buying shares of a company gives you partial ownership. If the company grows, the value of your shares increases. Bonds. A bond is essentially a loan you give to a government or company. They repay you later with interest, making it generally safer but lower return than stocks. Funds. These combine many stocks and bonds into one package, spreading risk across multiple investments. Examples include mutual funds and exchange-traded funds, ETFs. Real estate. Buying property with the intention of renting or reselling it can generate ongoing income or profit over time. The power of investing comes from compound growth. When earnings are reinvested year after year, small amounts can grow significantly. For example, modest monthly contributions to a retirement account can grow into a large sum over decades. However, all investments carry risk. Markets rise and fall, and values can change suddenly. The key to successful investing is patience, diversification, and time. Wealth is usually built steadily over decades rather than overnight. Value. Value is the measure of how much something is considered worth, but it isn't always tied to physical usefulness. Instead, value is often determined by perception and scarcity. A regular rock might have little worth, but if the rock is gold, society assigns it a higher value because it is rare, desirable, and trusted as a store of wealth. In economics, the ability to create or provide value is what generates income. For example, Steve Jobs and Apple created the iPhone, a product so valuable to millions of people that they were willing to pay hundreds or even thousands of dollars for it. The same principle explains why doctors and lawyers are well paid. The services they provide are highly valuable, and people are willing to spend large sums for them. Value is also linked to branding and perception. A handbag from Louis Vuitton or Gucci may be functionally similar to one from a budget store, but people pay far more because they perceive it as more valuable. This shows that value can be real based on usefulness, or perceived based on reputation, status, or rarity. Understanding value is essential in finance and business. If you can create or offer something that others consider highly valuable, whether it's a product, service, or brand, you can generate significant income. The higher the perceived or actual value, the more people are willing to pay. Time. Time is the most valuable asset because, unlike money, it cannot be replaced. Everyone starts with a certain amount of it, but no one has an unlimited supply. Most people trade time directly for money through hourly wages or salaries. For example, 1 hour of work equals 1 unit of pay. However, the most successful people increase the value of their time. They develop skills, build systems, or create products that allow them to earn far more for each hour invested. Some leverage their time through businesses or investments so that their money continues to grow even when they are not actively working. In investing, time is the most powerful multiplier. The longer money is invested, the more compound growth has a chance to work. For instance, a modest amount invested early in life can grow into a significant sum by retirement simply because it has decades to multiply. This is why wealth is usually built over years, not days. Ultimately, how time is used determines financial outcomes. Spending it only to trade for wages limits potential growth, while investing time in skills, businesses, or long-term investments can transform small amounts into large wealth over a lifetime.